Hello, and welcome to the Mid-Year Economic Update. Today we'll be discussing a brief economic review of the first part of this year and strategies to consider moving forward. As you may know, there are 5 key areas of financial planning: protection, retirement, investments, tax planning, and estate planning. As a holistic wealth manager, our goal is to provide comprehensive financial planning and incorporate these 5 areas when helping clients with their overall financial picture. The year 2018 started off as a very interesting one for investors. In January, as this chart shows, the S&P 500 continued its upward charge, but by month's end, things changed. By February, investors saw the return of volatility and heavy downward movement. This seesaw action continued through March. April was a little more tame, and the major indexes squeaked out a minimal gain. But as this chart clearly shows, the low volatility and straight upward path of equities was changed in 2018. If you look at a one-year chart, you see that the overall market is still up over the year's time. But once again, 2018 is not the same pattern as 2017 was. A 10-year chart shows that long-term investors are more likely to have a better return, even though the 10-year chart includes a downturn from late 2008 through early 2009 and again in 2018. For most investors, equity holdings should be thought of as a long-term investment, and many times, time can help returns. However, we must all understand that past performance does not indicate future performance, and therefore, we should always monitor the current situation carefully. Volatility, as measured by the VIX, or Volatility Index, clearly shows that volatility is back. The outlook is for more stock market volatility. That means investors need to be watchful and not necessarily fearful. In fact, market movements up or down or volatility is a part of investing. Let's now take a historical look at the S&P 500. The fluctuations investors saw have raised some concerns. The data includes: the S&P 500 moved up or down 1% or more 23 times during the first quarter, 3 times the number of days in 2017. In 9 years since 1958, in which the first quarter had between 20 to 25 days of up and down moves, the remaining 3 quarters all had above average up and down moves, with an average total of 86 up and down 1% moves in the year. The average total return from those 9 years is positive 9.6%. Historically, the most volatile months include June and August. Remember, an index, whether it's the S&P 500 or the Dow Jones, isn't a measure of your portfolio. Fluctuations are part of investing, and it is expected that the market will experience its ups and downs. Analysts are still in debate on whether or not the bull market is still in its prime or on its way out. Let's review equity markets since the last presidential election. Since Election Day, equity markets have advanced. After investors experienced strong returns and low volatility in 2017, they have faced a high level of volatility in the first part of 2018. The Tax Cuts and Jobs Act provided a bit of a boost for corporate earnings, but equity prices were still volatile. There are many favorable signs for investors. These include increasing but relatively tame inflation, still historically low interest rates, the tax cut effect, record corporate profits, high consumer confidence, extremely low unemployment, improved overall economic activity. Issues that raise concerns for the equity market include: number 1, domestic politics. Tax laws were passed, but health bill uncertainties, budget deficits, and political fighting still continue. Second, international relations. Tariffs and protectionism behaviors are still uncertain, and equities do not like uncertainty. Third, inflation is currently low, but some economists are predicting inflation will rise soon. Fourth, interest rates are moving upward, which means the cost for borrowing will go up. Fifth, regulation and deregulation. Facebook's recent inquiries have brought up some very serious conversations over regulation and deregulation. Sixth, S&P 500 valuation. Depending upon who you follow, many people feel that some equities are still on the higher side of historic valuations. As you probably know, a major area for equity investors to watch is the Federal Reserve. In February, the Federal Reserve welcomed a new head, Jerome Powell. Powell has been a member of the Fed's Board of Governors since 2011. In the Fed's first meeting under Chairman Powell, the Fed continued its expected path of raising rates 0.25 percentage point to a range of 1.5% to 1.75%. The Federal Reserve held interest rates steady at their May meeting and expressed confidence that a recent rise in inflation near to the U.S. Central Bank's 2% target would be sustained, leaving it on track to raise rates again in June. The central bank currently forecasts another 2 rate rises this year, although an increasing number of policymakers see 3 as a possibility. Investors overwhelmingly expect a rate hike at the Fed's next policy meeting on June 12th and 13th. The 10-year U.S. Treasury yield on Tuesday, May 1st, moved about 3% for the first time since 2014. It's a psychological level for the markets because we haven't seen 3% 10-year yields since 2013. The 10-year is potential competition for stocks, says David Cass, a professor of finance at the University of Maryland. Yield is a simple concept. It is the current income return you receive when, for instance, you own a bond as measured by a percentage. If the bond you bought for $1,000 pays you $30 per year, that's a 3% annual yield. The 10-year U.S. Treasury's stature as a benchmark comes from being perceived as risk-free. 3% by some economists is viewed as a key threshold for a number of reasons. Three main reasons are mortgage rates, the stock market, and corporate debt. If corporate borrowing becomes more expensive, that could lead to corporate projects or expansion being put on hold or canceled. Remember, while interest rates are up from a year ago, they are still at historically low levels. 6% is the 60-year average for a 10-year Treasury. Investors always need to be watchful of interest rates. As this chart shows, for the first week of May, the average for several key interest rates that investors see are still low and might not help all investors reach their goals. As you may already know, when interest rates rise, bond prices go down. We try to keep a watchful eye on both interest rates and bond prices. As this chart shows, in April, the United States unemployment rate hit 3.9%, which is the lowest outright level since December of 2000. There are some noteworthy things to know about this. First, this is a very good employment level. Also, in the recorded history of monthly unemployment figures, only 10% of all months have been better than this. Now let's review potential trade wars and the recent tariffs on China. For a brief background, China is the world's second largest economy. In the first quarter of 2018, China reported its economy grew 6.8% from the same period in 2017. Earlier this year, President Trump imposed tariffs on steel and aluminum from China. What does the possibility of a potential trade war between the U.S. and China mean for the economy? While the Chinese president has made it clear that China is not afraid to retaliate, the Chinese ministry stated that China doesn't want a trade war, but is not afraid to fight one. Current and suggested future tariffs represent uncertainty, which equity markets typically do not find favorable. We are keeping an eye on the global economy and how it may affect the markets. The key point to remember is that as an investor, you should remain non-emotional and not make rash decisions based on any one isolated set of facts. As always, we are closely monitoring all clients' personal portfolios and goals. In addition, although we're not reviewing taxes in detail on this presentation, there were some major tax law changes. One of our commitments to clients is to try and learn how new tax laws could possibly react with your investments. As we all know, uncertainty can either create problems or it can create opportunity. We are in a rapidly changing environment. As an investor, you need to prepare so you can analyze any environment safely. Also, as an investor, many of you can be and should be concerned about your situation. Generating high returns can many times be risky, and having diversification can be a challenge. In today's low interest rate environment, conservative and moderate investors may have returns that are not as fruitful as those portfolios with more risk and full equity exposure. A well-diversified and balanced investor will have returns that are reflective of benchmarks that hopefully include some safer returns than full equity exposure. In this rising market, that means a well-diversified and balanced portfolio will most likely always generate lower returns than a full equity portfolio. While higher risk has been rewarded for some investors in the current market, investors who are fully invested in equities are usually aggressive investors, and that means they can endure extensive volatility and potentially significant losses. Moderate investors can be described as middle-of-the-road risk takers. They are aware that the markets go up and down, and they are typically okay with that if it means there's potential for growth. Your focus should be on working toward your own personal goals. 4 things you should remember are: as I mentioned earlier, an index, whether it's the S&P 500 or the Dow Jones, isn't a measure of your portfolio. It's what your portfolio is doing, not what the market is doing, that is important. And your portfolio doesn't always move in lockstep or sync with any single market or index. Your portfolio is different than everyone else's and should be based on your own personal goals, risk tolerance, and time horizon. So what should you do as an investor? Now is a good time to reevaluate your investment goals and objectives. Are you comfortable with your investment strategy? You should also confirm your investment timelines. Are they short-term or longer-term? You should also reevaluate your risk tolerance and rebalance your portfolio accordingly. Are you still okay with being conservative, moderate, or aggressive? Make sure your investments match your risk tolerance level. We believe the best approach to financial planning is to be comprehensive. So in addition to reviewing your investment planning, don't forget that reviewing your retirement, tax, and estate plan on a consistent basis is always wise. We try to see if there are any appropriate changes or opportunities that have arose from your personal situation. Particularly with Trump's proposed tax plan, changes may be on the way. We will help you stay apprised of any changes and how they may directly affect you. Our focus is to meet your personal objectives. Our focus is you. We know that advice is not one size fits all. As your financial advisor, we aim to help you make the journey toward your goals easier. Our goal is to continually monitor your situation. So what can you expect from us? You can expect constant communication, a regular schedule of client meetings, and you can expect that we are constantly reviewing economic, tax, estate, and investment issues for our clients. We focus on your personal objectives and try to understand your personal commitments and comforts so we can tailor a specific overall financial strategy for your goals. As you know, our role as your advisor is to maintain a non-emotional objective, avoid knee-jerk reactions, assist you in making decisions that are always in your best interest, and again, we will be here for you.